Hello, welcome to the Economic View today. I'm joined as always by Evan Lucas, our Chief Market Strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, very good. Look, I wanted to talk about the US and China trade war. It seems to have been simmering along. There was talk yesterday about getting the US and China back together at the negotiating table, but we've had some more developments. So let's talk about that.
That's an understatement in terms of having more developments, because You're right, it's a complete 360 to what we were hearing. So you're right, last night there was talk about that there was actually sort of sparks that the negotiations were back on in earnest. But what has happened on Wednesday with the US Trade Representative in Robert Lighthizer has come out and proposing, so it's not enacted yet, but when it comes out the way it's come, it will happen in terms of what you look at, is proposing to raise the tariffs on the 200 billion of additional Chinese tariffs to actually be 25% rather than 10. Now that is a substantial increase in tariff. That's a substantial increase in pricing cost. It also looks like it could spread into the enacted $50 billion that are already out there on the products that are being imported currently. So this is a complete step in the wrong direction if we're honest about where we're sitting. If you have a look, and I really wanted to show you this chart, this is the initial reaction from the US futures market. So this is the E-mini contract for September. You can see very clearly that on the release of this news, when it basically hit Bloomberg and hit Dow Jones Newswires, that we saw over a 10-point movement. Now, on a day like what we had on Wednesday, where Apple reported pretty decent numbers and the S&P had a fairly good day, to move that kind of number that quickly after hours shows how much of a detriment this has and how markets are taking it. So it is... There's no doubt this is going to be the biggest story of the week now.
Yeah, and it's quite unexpected in a way, because we all knew that this is going on, that these tariffs have been announced. Then we were at the stage of perhaps sort of settling the whole issue down, getting US and China back to the table, because ultimately, it's not in the best interests of really global economics to have this going on.
And on that, like, what's been really interesting is listening to, it's US earnings season, and listening to the earnings forecasts from the firms that this really affects. So you actually, the one to really highlight here is Caterpillar. Caterpillar had a really, really good result, but in their outlook, they actually stated that they're going to have to increase prices to offset the cost of tariffs. Now, they are directly related to the steel and aluminium tariffing. So they are feeling it not just from what's going on in China, but they feel it through Canada, through the European Union, and the tariffs that are happening there. So it is actually affecting them directly at home. So this is the other catch around this, is that although you do have this scenario where they could back away, in the end, you've got to remember the Americans are net consumers. They are a net consuming nation. That's why about 55% of their GDP is on consumption. And when you do have that, you're going to have deficits in, trade with other major exporting nations, being China, but Europe is another one. Same with Japan, which is why we keep talking about this. This is not the way to even that up if that's what you're trying to achieve. And if anything, look, it certainly politically plays well at home, because obviously it does look like he's trying to enact a way to actually narrow that gap. But what you will see is that those, that go to a Walmart, those that go to, your JCPenney's of this world, etc., that actually do buy Chinese goods off the shelf, they're the ones that will find this hitting them.
The flow-on effects are enormous. Yeah. And as you were saying, other companies such as General Motors, are saying that this is already having an impact on them, and it's going to flow through into results. So, you can expect that that will flow through to us in terms of the price of cars.
Yeah, so the next thing to now watch is, firstly, obviously the reaction from Beijing. So that will be very interesting to see what happens with regards to how Beijing react to this over the 24 to 72 hours of the rest of the week. I think what also needs to be highlighted is what the Chinese are currently doing with the renminbi. So everybody's talking about the yuan. It's hit 3.5-year lows. I think this is a signal that they will accelerate the depreciation of the yuan to $7. So it hasn't been there for 4.5 years. They've actually sort of allowed it to naturally appreciate, to keep the Americans happy, to probably put the currency back where it should be if you do want to look at how currency should be trading. But this will be a signal to Beijing to probably do that. And the reason for it is, as we've talked about before on this program, is to try and mitigate what the Americans see at their end. So what I mean by that is that if you're paying 7 yuan to a dollar, it will appear cheaper to a US consumer. So if you can sort of take that hit in the tariffs by reducing your currency, then that will actually therefore reduce the impact on their exports to the US, but it certainly won't absorb it. And to do that requires so much capital to flow in and flow out of the country, and they don't want outflows like they had back in the day, because therefore it leads to issues around debt, it leads to issues around stability, and again, it leads to financial issues. But at the moment, it looks like they'll probably will go down that route. So that's the next thing to watch.
Yeah, and the other trump card, sorry about the pun, the other trump card that China has is all these US Treasury bonds, and they've already been selling those down, but they could do that at even more so.
They could. The catch there, as I just alluded to, the caveat is that they also have stability that they need to sort of weigh up. So you're right, they could flood the market.
It's a balancing act.
It is. And the other interesting thing is that they would probably be losing out, considering what we've seen in the US sovereign market. So if you look at the US 10-year and all that kind of market, it is now down. So we're talking about a yield of 3%, which means face value is probably below 100. So you're losing value. So there is a catch-22 for them, is that yes, they can certainly flood the market, but the capital loss would also be an interesting one. And again, that outflow. So it's a bit a higher end, and that's fine. But there is so many moving parts to this, and that's why the initial reaction is clear. It is seen as a negative.
Well, we're going to be watching this space, and we'll be watching it very closely. Join us again next time for The Economic View.